Hi, everybody. This is Alex Fensky, the lead agent for the Chicago Southland Homes team at Keller Williams Preferred Realty, and I'm here to give you the August 2023 housing market update. I'm going to give you some very valid and relevant information about the northeastern Illinois / Chicagoland metro area real estate market. But just know that if you're thinking about making a specific real estate move for your home or investment property, even this is too broad for you to actually use to make any decisions. I would want you to reach out and we can talk about your plans if you have any questions or you've got some plans for the next few months. With that said, we're going to cover some metrics around supply and demand and the way that those two work together, what impact that's having on prices, what's going on with mortgage rates, and some general advice on what to think about if you are planning any real estate transactions. So first off, let's talk about supply. Now, supply right now is still right around record lows, and we're at a point now where it's even going against seasonal norms. So here's what I mean. Number one, we're going to look at the number of homes that were listed for sale. I'm going to go to a 3-year chart here so there's not too much noise. So you can see here, this is the number of new listings each month. And you can see there's a very regular pattern as it goes up and down throughout the year. That's typical seasonality. And typically you can see March, April, May, June. This is when most of the listings come on the market. And then it kind of goes down through there. Usually July is going to be less than August, but still in the same ballpark. I'm sorry, July is going to be a little less than June, but still in the same ballpark. And you can see here what happened in this July is not what normally happens. We actually fell off quite a bit from an already low number. And what you see up in the corner here is that the number of homes that were listed for sale in July was 26% fewer than in July of last year, which was lower than the July before it, and so on and so forth. So it's actually the fewest new listings of any July on record. Beyond that, it's down 39%. The number of homes for sale is down even more, down 39% compared to this same time last year. That's a huge dip from an already low inventory level. As you can see, the dot at the bottom of the chart here, 15,301 homes for sale as of the end of July. It's not the lowest number we got on record, but it is darn near the lowest, and it's right in line. It's tied for second place with 2 other months this year. If I zoom out on this chart, I'll take you to the maximum. It's only gone one direction. That's down, and it's still gone down even after 2021, which is what most people think of as the height of the market. In most ways it was. But certain things haven't changed since then. And one thing that hasn't changed is that the overall trend of housing inventory continues to be down to the point where we got 15,000 homes for sale right now. And this highest point on the chart in July of 2008 was 109, almost 110,000 homes for sale compared to 15,000 today. So by the way, quick side note, I still hear some people talking about like, oh, there's going to be this crash and whatever. This is a drastic and fundamental difference in the amount of one side of the equation, which is supply. Now, we'll still talk about demand, but you can see how drastically different it is today on the supply side. All right, let's zoom back in a little bit, and we're going to talk about demand. First, we'll look at pending contracts. The number of homes that were under contract as of the end of July was down a little, but down only 3.2% compared to last July. And that's a smaller, we've been seeing lower numbers year over year in that way, but 3.2% is a very small lower number, the smallest that I can recall seeing in a while. So that actually is relatively stable. And if you look at this on a 12-month rolling average, right? So that kind of eliminates seasonality. When we say seasonally adjusted or seasonal average, we're taking 12 months of data to smooth out some of those bumpy things and look at the trends a bit more. And what you can see here is that pending contracts have been on a steady decline since May of 2021. It's been a fairly smooth ride down. but a steady one. But you can see here at the end, the last few months, that 12-month rolling average has started to flatten out. So the drops year over year have started to shrink, and the number of pending contracts, which is a good measure of demand, is stabilizing. So the demand is still softening, but it's starting to flatten out and moderate a bit. The other metric that we use to look at demand is the number of closed sales. But remember, every closed sale has to have a pending contract before it. So the pending contracts are a little bit of an early lead on the information before a sale closes. You can see here that closed sales have not started to flatten out yet. Those are still going down compared to prior years. In fact, in July, our July closings were down 24% compared to last year. So take a look at this. About 9,300 closed sales this July, about 12,200 closed in July 22, and almost 16,000 closed in July of 21. So that's two big drops. And so when things feel a little bit different in the market, there's just not as many transactions closing, quite a bit fewer, maybe 55 or 60% of the number that we're closing in the summer of 2021. Of course, 2021 was a weird year because if you look at a farther zoomed out chart, it's certainly, 21 was an apparition. It was way up here. And this is the past 10 years. It was relatively consistent throughout that time. So closed sales are down and still dropping, but I expect those to flatten a bit because contracts flatten a bit. And that's the leading indicator for demand. Let's now take a look at some of the metrics that tell us how supply and demand are working together. One of those is my favorite housing metric, months of housing supply. So as always, I'll give you the quick explanation of this. Months of housing supply means if you took the number of homes that are for sale right now, and you took the number of homes that are selling each month, and you say, well, theoretically, if nothing new came on the market, how many months would it take to whittle away all the existing inventory? And so we call that figure months of supply or months of inventory. 5 or 6 months is considered a balanced market, meaning it would take 5 or 6 months for buyers to buy up all that inventory. If there's more than that, longer supply than that, that means it's a buyer's market. There's too many homes available for the number of buyers. Prices tend to drop because sellers are competing for the rare buyers and lowering their prices. On the other side of it, when supply is shorter than 5 or 6 months, that's a seller's market, and there's not enough homes for the buyers who want one. And so it's the buyers competing for the scarcely available listings, and they do so mostly based on price. So when you have shorter supply, it tends to move prices up over time, and then we call that a seller's market. So in this case, when we're looking at July housing supply, it's showing you 1.7 months. You can see that there's a seasonal pattern here as well. So if we look at the seasonalized average, you can see, wow, it's actually been crazy stable. 12-month rolling average housing supply is at 1.8 months, and it's been bouncing around between 1.7 to 1.9 since January of 2022, arguably December or even November of 2021. It's been from 1.7 to 1.9 months of housing supply. So what's happened is we just went over how much supply has dropped and then also how much demand has dropped. What I'm saying here is they've both dropped by about the same amount, so that the relationship between the number of buyers and sellers in the market is no different than it was in late 2021. Pretty crazy, right? So one thing that I will show you here is that if we go all the way back to the max, we've been looking at going back all the way to 2008. It's become more and more of a seller's market basically the entire time since then, with a couple little blips in the radar. Kind of crazy. There are a couple of areas that supply got very high, well in excess of 6 months here in the last year or so. Most of those areas are back down. Most of those areas are now back under 6 months of housing supply. Tends to be a lot of the neighborhoods in the south side of Chicago. I know that Greater Grand Crossing, South Shore, I believe Auburn, Gresham, a lot of those areas had supply that got all the way up to 9 months or higher. Most of them are back down under 6 now, but a couple are not. So when I say real estate's hyper-local, I really mean it. This is not the same everywhere. One other metric that we'll look at in relation to supply and demand as they combine is the number of days to contract. So this, you might also hear this called market time, how many days between the day a home is listed and the day it goes under contract. including the time that it takes to receive the offer and negotiate and sign the contract before the status is changed. So this number includes that time. And you can see that on a monthly basis, that number is 7 days median to contract. Because you see seasonal patterns here, we'll take that away. What does it look like without it? 10 days. It has been between 8 to 10 days since July of 2021. That is a full 2 years. Median days on market has essentially not changed. So if you've got a home for sale and it's in a neighborhood where supply is like the normal, and it's more than 10 days on the market, it might not be priced right. Because if it were, this says that it would be sold. So that's something important to keep in mind. Now, what everyone wants to know about is prices. So all these other things are what lead to changes in price, along with other factors like the cost of money. So I got to move my screen over because this curve has hit the top. Another thing that hasn't changed in basically 2 years is the median sale price. Sure, there have been little tiny bumps, but I mean, $1,000 or less. And this is over the entire Chicagoland area, over hundreds of thousands of sales. So basically going all the way back here to October 2022, the median sale price in our multiple listing service has been $290 flat. One difference this year is that compared to last year, January, February, March, April, May, all those months, the median sale price was lower than the same month of last year. Then in June, it was a tiny bit higher. And in July, it actually was 4.3% higher than July of last year. And that's why you saw on the seasonalized average that little blip kind of went back up because there's a little chunk out of it from some of those slightly lower months. And now we got a slightly higher month. So overall, it's remained a bit steady. But overall, if I'm to describe pricing right now, I'd say it's pretty flat. Want to see something that's not flat? Mortgage rates. Mortgage rates are always crazy all over the place. They remain fairly volatile. I'm going to zoom in on this chart here in a second that you see here on Mortgage News Daily. This is a great website for mortgage data. But what I first want to highlight is the 30-year fixed rate mortgage is currently running at 7.13% on average. You can see that your government-backed loans, which is your FHA and VA loans, are right around 6.8. So about a quarter point lower than a conventional loan. A 15-year is going to be about 0.65, so 65 basis points lower than a 30-year fixed. You get a little bit of a discount, but it's not that much of a discount. And then the 5/1 ARM is barely getting you a discount at all, less than 20 basis points. The differences between all these loan products are sort of related because it's banks lending money. But different interest rate outlooks and economic projections affect these things differently because of the way that financing is structured on the secondary market. So that's why these are different, and the gaps between them or the differences in the rates are not always the same either. Right now, you're not getting much of a discount for a 5/1 ARM. Probably doesn't make any sense to go get one because you would expect to see a larger discount in order for you to take on a product that the rate can eventually change. So what's going to happen with mortgage rates? Oh, wait, before I do that, I told you I was going to zoom in on this so you can see this is the last 12 months of 30-year fixed rate mortgage. And you can see, we're back towards the high side of where it's been, but still within the normal range. The highest we saw was October. But if I just look at, let's just say I'm going to look at the last 4 months or so. So this is the 7% line right here going across. And back in May, we crossed the 7% line. We've been below and above it, but hovering right around it for the last 3 months or so. So that's the recent history of mortgages. So what's going to happen? Everyone wants to know what the Fed's going to do. At the July meeting, the Federal Reserve raised the overnight borrowing rate by a quarter point again. They didn't change it in June. They raised it one more time in July, and everyone's kind of split on whether they think they're going to raise it any more this year. So there's mixed news on all that. The point of raising the federal funds overnight borrowing rate is to try to cool down the economy because inflation was up over 9%. They've got it down to 3%. That's still not where they want it. They want it more like 2%. So they got a little bit more to go. But the job market is still tight. Unemployment is still actually at a number that's a little too low. But at the same time, GDP growth is a little bit lower than what they want to see. So trying to balance all these things and trying to move the economy in such a way that they cool it off enough without cooling it too much and sending us into a recession where GDP shrinks. That may be unavoidable. We'll see. But right now, the markets are about 50-50 on whether there's going to be further interest rate increases from the Fed this year. So with all that said, what are you going to do about it? What should you do about it if you're a buyer, if you're a seller? Here's what I'll tell you about sellers. Sellers, you do still have the upper hand. I mean, you saw all this data. Pricing may not be going up a whole lot, but it's a seller's market for sure. That means there's more buyers than there are properties for sale, and they're competing for your property. But because pricing's flat, you still got to price it right. You still have to compete. You can't let it go to your head. You still got to compete as a seller, and you still got to really price carefully. So listen to an experienced agent on what a competitive price will be. So make sure that you're one of those homes that sells in 10 days and not one of those 29% of them that doesn't sell. Buyers, we got to talk about tough love here for a second. Buyers, I hear there's a lot of people saying, waiting for rates to go down, waiting for rates to go down. Well, if you're waiting for affordability to improve by any significant measure, you might die holding your breath. Even if rates go down a bit, which I am sure they will. I'm sure because you see that fluctuation, there will be times when they're lower than they are today. That's 100% certain. There will probably be times when they're higher too. But if you want to wait until then, and we just showed you the last 2 months, prices are higher than they were the same month a year ago. What do you think happens if mortgage rates drop by a substantial amount? I mean, what if mortgage rates suddenly were back in the fives? What would happen? Well, a bunch of other buyers who have been waiting just like you are going to come off the sideline. And when they do, they're going to go back to being able to compete more on price because they can borrow more money at a little bit less cost. A lot of sellers that have been waiting to buy something else because they don't want to give up their mortgage rate, they're going to be back in the market. And by the way, a bunch of investors who have been waiting because borrowing rates are too high for them to cash flow on a rental, they're going to get back in the market too. So when you see rates go down by a significant amount, because there's a lot of pent-up demand right now, you're going to see prices go back up because there's no supply. So, and the only one of those groups that I just described that is going to add to supply is the sellers who are also buyers, but they're not going to add anything. They're not taking away because they're selling and buying. So for the buyers who are thinking, let me wait till rates come down, I don't know that I can tell you with any degree of confidence that housing affordability is going to be better in the future at any point than it is today. You have to make a sound decision. You can't buy too much house. But if you are able to afford a home that you can see yourself living in for at least 3 to 5 years right now, you should do it now. And I think you'll thank me later. And there's a whole bunch of other reasons why, other than just the price and the payment. But that would be my tough love for buyers here in August 2023. Again, if you have any questions or you want us to take a look at a scenario for you, just drop a comment, shoot us a message. Be sure to subscribe to the channel here so you get our future housing market updates and some of the other fun stuff we're doing. My name is Alex Fensky with Chicago Southland Homes at Keller Williams Preferred Realty here in Orland Park. I'll see you next time.